Good afternoon. Many of you may not know me. I'm Roger Aguinaldo. I'm the CEO and founder of the M&A Advisor. Obviously want to talk about what's going to go on in the year ahead, and I think this is a perfect panel for this. We got representatives from law firm, private equity, banking, and accounting, and due diligence. This session is presented by and sponsored by PwC. So thank you for showing up and listening to this next session. I'm going to introduce our moderator, and he'll introduce the panelists subsequently. David Sanders is a partner and co-chair of transactional and securities practice over at law firm Foley and Lardner. Please give a hand to David Sanders.
Thank you. So what we're going to do today is I'm going to introduce everyone, and then they'll say a few words about what they do. Then John Potter of PwC is going to present to us on what he and PwC see coming down the pike in 2014. And then we're going to ask, I'm going to ask a few questions of each of our panelists as to what we see coming down the pike in 2014 and 15 for M&A. And then there'll be time for questions in the end. Now, at the end of the day, this is something we're putting on for you. So if you all have questions you'd like to see answered, we'd encourage you to raise your hands and submit those questions. We're happy to field anything you have that's forward-looking is what we all see and predict to be happening in the coming years in the world of M&A. So we've got John Potter from PwC, Jim Custer, who's the head of M&A and corporate finance at RBS Citizens, and Garrett Baker, who's the president of Waller Capital Partners. So I'm going to turn it over to Garrett to introduce himself, and then we'll go this way, and then we'll move on.
Hi, I'm pleased to be here. I'm Garrett Baker. I've been at Waller Capital for about 16 years now. Waller is a 30-year-old boutique investment bank that specializes in telecom, media, and technology. A big chunk of our business is with traditional media and telecom companies, but an ever-growing portion of the business is among new technology companies focused on digital media, internet, social media, etc.
I'm Jim Custer, and as David said, I'm head of M&A corporate finance for RBS Citizens. For those of you who don't know, the name RBS Citizens, it's what is the corporate banking and capital markets parts of Citizens Financial Group. And Citizens Financial Group is currently 100% owned by RBS. It's a regional bank here in the States. It's got about $125 billion in assets, quite a stable portion of the larger RBS. Citizens has announced it's doing an IPO next year. It's going to be the largest bank IPO in U.S. history, and we're looking forward to getting independence. The main purpose for the IPO is to get spun out of RBS and chart a path independently as a regional bank here in the United States. So in part of that plan for Citizens going public is also a broadening of Citizens' product offering and capabilities, and so M&A is a key portion of that. We've got over 3,000 corporate clients. Many of them are really the core middle market, broad range of industries here in the United States, all domestic clients. So it's really, from my point of view, it's a great way to tap into what's actually happening across a number of industries here in the United States.
I'm John Potter, partner at PwC. I'm a markets leader. So aside from spending time working with clients, primarily corporate clients,
I'm active in really collating our firm's observations around what's going on in the M&A market.
We're going to turn it over to John again to give us an overview of PwC's report on M&A in 2014.
Great. So, I think this is a topic we're forward-looking, so absolutely encourage debate and counterpoints to view of where the market is. I think as we looked at the past 3 to 4 years, we've seen what has been a very strong U.S. market. I think we were all hesitant to say that because we remembered 2006 and 2007, and we thought that was strong, so what we've had for the past 4 years must not be. But in reality, the volume of M&A activity has been very consistent over the past 4 years, very consistent with what I would call the historical average outside of the bubble years of 99, 2000, and 2006, 2007. Now, clearly we see there's capacity in the market for more transactions. When you look at the overall growth rate coming out of the Great Recession, the world is tripping around 2.5% real GDP growth. That's not a fast growth rate, and that's not a fast trip back from the recession. However, the U.S. has certainly been the global leader and the market in which there's the greatest amount of confidence. I think when you look at overall M&A activity, it's clearly evident that the U.S. has been much more resilient in terms of its activity in M&A. And you look at total global activity, clearly the rest of the world is where the significant drop in volume and valuations happened over the past 3 or 4 years. Now, looking at how that plays out, part of the reason we've had a lot of strength in the U.S. recovery certainly is the fiscal policies, the investment from the government. Partly it's the change in energy. I mean, that fundamentally shifted our strength as a productive economy and allowed us to be positioned well. And it's also part of the I'll call it increased consumption as we slowly worked out from the Great Recession. So looking at where we are in 2013, as I said, the volumes are relatively flat to last year. We all rushed into Q4 last year, given the pending change in capital gains. We saw a lot of transactions. However, in Q1 and Q2 this year, it slowed down a little bit. There was a pull forward of activity. Now, coming into Q4 right now, the market is amazingly busy. I mean, speaking from me and my partners, there is not a single person looking for something to do right now. The enthusiasm for getting transactions closed right now is tremendous. The difference from last year is it's more focused on a confidence in forward valuations, a confidence on earnings growth. Valuations are increasing. The availability of capital and the broader circumstances for transactions clearly make it very viable to do deals right now. There was a conversation this morning around valuations, and is the equity market overvalued? I think the valuations in the equity market certainly creates an environment where it's difficult to take a company private. Given the control premium that we'd expected and the pricing and the valuations, that's a different deal to do, difficult deal to do right now. But when you look at the private company transactions and the multiples out there, while they've certainly increased, and in many sectors are right back to where they were in 06 and 07, the discussion of is the market overvalued is a little less consistent. I think it's specific to the sectors in the market. But what we are seeing is greater confidence in the forward earnings. And I think that confidence concept and the ability to achieve the expected value in the future is what's driving a little more activity now. We've seen more transformative deals, which to some can lead confidence in executing their own transaction, and to others might suggest that time is to wait. So overall, the momentum we've seen coming into the fourth quarter it bodes well for how 2014 will play out. Certainly the pickup in economic stability in Europe is a positive for a region that is important to M&A. The stabilization in China, while we're not going to see the 8 to 9% growth rates and probably not the 7% that we're currently at, I think is a positive factor towards overall Asia growth around 6%. And then when you look at Brazil as the leading South American economy, clearly the currency volatility has created some concerns, but we're seeing stabilization there. And you can't ignore the fundamental growth in the South American, Latin American market around population growth, income growth, and just a fundamental demand. So overall, the conditions are set, economic conditions are set, confidence is there, and I think businesses that have shown the discipline and ability to create value over the past 3 to 4 years are well positioned to now search for that revenue growth, which is really what's going to drive long-term value, and where I think the market and really the pressure on executives is focused is to deliver the revenue growth.
Well, thank you, John. And I'd like to take off on something you said about the fact that when you look historically, there's this perception, and I think we share it whether we're bankers or private equity folks or lawyers, that we're not as busy as we were. And that 2013 is a step in the right direction, but we're not all the way there yet. But you produced some data, and PwC produced some data that shows when you take out those peak years, we are more or less still on that upward trend. So you read a lot about private equity firms and venture capital firms that have all of these portfolio companies, many of which were bought in the bulge years of 06 and 07. And I think there's still a perception out there that we're still waiting for this fire hose sell-off from the private equity firms of all of these portfolio companies that they own. And I'd like to start, and I think obviously we'll start with Garrett being the resident private equity person on our panel, on what should we look for? Are the factors ripe for this private equity sell-off? Is it something that is happening little by little and there won't be the fire hose? And what indicators should we look for in the climate, in the transactional climate as precursors to that sell-off taking place?
Yeah, it's a good question. I think you have to keep waiting for the fire hose. We've seen consistent activity over the last few years. I agree with what you both said around the overall activity level the last 4 years being just as high as it's been historically, in 12 and 13 in our sectors and in our firm even higher than it's been historically. As far as private equity, supply and when that's going to be coming out to market, I think two of the factors that have slowed that down a little bit are access to cheap debt capital. And a lot of our clients have looked to achieve liquidity for their portfolio companies, and as they've gone out to market, have weighed the opportunity to sell their businesses against the opportunity to recap for really attractive interest rates and really attractive terms, and chosen to keep the company and pay themselves a big dividend. Same thing on the for IPOs. They've had the alternative of going public, and the IPO market has really come back as a real alternative in the last 2 years or so. I'd point out that many of those IPOs have not traded well post-IPO. So if you look at what's going to happen to those two alternatives, IPOs and recaps, I think there's some evidence to suggest that they will not be as attractive going forward. People are a little more reluctant to go public because of how the stocks have traded. And then on the dividend recap side, as quantitative easing starts to go away, the recap alternative won't be as attractive either. So some of these companies that have sort of built up are going to start to become loose. I think you'll see an increase in M&A activity, but not the fire hose that we're all hoping for.
Well, we can all hope, and I think the good news is, from what you've just said, that hopefully this means that over the next several years we'll all stay busy and not face times like we did in 2008. So, Jim, do you have anything you'd like to add to that?
Well, I definitely agree with Garrett's observations on dividend recaps. They've really provided tremendous liquidity for private equity. And, there's been, I think, over 75 private equity IPOs this year, so that certainly takes a little air out of the M&A pipeline. But I do agree that next year's there are a number of factors that are going to change that. I think what I tend to base my viewpoints on, there's a foghorn going off here. One of the things Citizens Bank has done for the last 3 years, taking a lead from our colleagues here at PwC, is to do a fairly in-depth survey of our clients around M&A and their intentions. And so we've done it for the past 3 years in the fourth quarter of the year. And we have a fairly large number of questions, and as I said, we have a client base of over 3,000. By the time we boil it down to what are useful portions of our survey respondents, it turns out to be about 500 or so. And so what's helpful for us to do is to see the trends in where the survey's coming out. And what I've seen between fourth quarter this year and fourth quarter last year is there are fewer companies that actually report themselves in the midst of an M&A transaction. And if you remember, fourth quarter last year was pretty busy. But there are a greater proportion of companies that predict that they're going to be in one shortly, which we didn't see last year. So I think there's a view towards 2014 that's pretty positive among the large number of middle market clients we deal with.
Well, that's great. And one of the things we talked about yesterday was that what you're seeing now are the size of the deals. There are more and more mega deals, the classic example being Verizon and Vodafone. But how does that play out in the middle markets, which we're talking about? So it sounds like from what you're saying, you are seeing more and more middle market companies looking to be acquisitive in the coming year.
Yeah, or they are, and I would pick up again on what your results showed, which is projections have more credibility now when you look out a year than they did a year ago. So if you're a buyer, although you're looking at largely higher multiples, there's been multiple expansion without a doubt in the last 12 months. But what you're basing your forward purchase price on is something you can get more confidence in and have better credibility in. So as you're doing your strategic planning for 2014, how are you growing your company? If it's not organic growth, last year was mostly about adding growth to your core product. This is also from the survey. This year it's more about adding additional sources of revenue, perhaps geographies, perhaps technologies, but maybe other products. I mean, just yesterday's announcement with Avago buying LSI, you look at those two companies, $6.6 billion acquisition, there really aren't a lot of overlaps into what they're both in semiconductors, but for Avago, it's really a big expansion into a whole new client base, products, et cetera. I think that's going to really dictate what happens next year in M&A.
Okay, great.
And you bring up an interesting point back to when's that fire hose going to, when you look at the average hold period of private equity investments, we all know that's continued to creep up. But the exit activity certainly has picked up on a great trajectory to this year. The PE exits are higher than they have been in the past 6 years. The optionality is fantastic, right? Recap's been a great way to create cash liquidity and still hold on the equity position. The IPO market is a good alternative. But the other thing that I would say is still keeping many of the investments in place and why they're not being sold now, if valuations are rising, if confidence in earnings are there, is because a lot of the investment, a lot of the change that's gone on in the portfolio companies has been about increasing the value creation in the business. So not just cost cutting to preserve the bottom line, but growing the business, changing the business to the point where the value of the business, it's not just financial engineering.
Right.
It's about the value of the business. And I think when I see private equities holding on at this point, it's because that pivot point is still 12 to 16, 18 months off. And that point of being able to deliver a business for sale where there is the confidence in the forward earnings says, you know what, while the market's good now, the time to sell this business is later. I think that's one of the trade-offs we are seeing, why there still is a good hold period on some of the investments
Well,
out there.
hopefully they were all listening at the previous session where we learned that March of 2014 was going to be the top. So they'll all sell.
Somebody called the top of the market already?
Yeah.
You can't do that till after.
No, he said he was going on record. So I canceled my vacation plan for March. I'm preparing to be busy. So let's shift gears a little. I think one of the things that we talk about a lot are which sectors and which segments we see as the next hot sector. We've seen all the data about real estate being in a really good place this year. Healthcare continues to be hot and will continue to be hot as we all try and digest Obamacare and what that means for the various placeholders and for the various stakeholders in the healthcare, different healthcare and medical device and pharma segments. What sectors that we're not thinking of commonly would you think have a chance to be the next hot sector? Start with John.
Wow, so you took out all the obvious ones, and now you get the next one.
Well, I didn't take out energy, but I just did. See how I did that?
Oh man, tough to find. All right. And I think that, the point. I think real estate. The challenge with the U.S. is if you look over any period of time, the diversity of M&A activity, given our diversity of our economy, one segment, you can never find one segment driving it. The volume, the value splits, you can see multiple expansion in certain sectors, but the fundamental diversity is great. Real estate this year, as you pointed out, has taken a much bigger chunk of the dollars, driven by the availability of debt capital and the fundamentals towards where value is in the real estate market. I think that's an interesting shift that will continue. But when you come into what's driving change, I'm going to point to technology, not as a sector, but as a fundamental driver of investment, innovation, and advancement. Technology is intersecting across the industries. You can look at examples in agribusiness, where technology is the investment that seed companies are making, or nutrient companies are making. You can look at technology as being, look at the mobile device concept, right? Simple way of thinking about how we're all connected. The number of mobile devices is well in excess of the number of people, and that's just going to continue. How does that drive technology and information and what's necessary for any business model, not just the telecom business model? So I think what I see happening is the crossover of the concepts of industries and how you look at where the M&A strategies are coming together towards those long-term strategies. And technology, to me, and that fundamental innovation, some of it disruptive, but some of it creative, is going to be the thing that you're going to see advancement in, whether it touches the healthcare industry, driven by certainly the Affordable Care Act, but the need for insurers to come at from a diversified base, whether you go to consumer and retail in terms of how you reach your customer and the customer engagement, or you get down to fundamental industrial products and have a competitive advantage, technology is a key part. So to me, that's one of the intersections I see as being really interesting in terms of how M&A fits into overall corporate strategy in the next year.
No, I think I would agree with you. And before we turn it over to Jim, I'll answer the question myself as well. One thing I see that also crosses industries is the importance of data and analytics and managing the data and not just gathering it, but interpreting it. And I think we're seeing a lot in the internet and a lot with technology where companies, regardless of whether they're in health or energy or whatever industry they're in, the analytics component and the companies that are behind the company, analyzing the data, analyzing the analytics, figuring out how to get eyeballs to stay on a website one more fraction of a second, how to click, how to get them more likely to click. I mean, they have people who graduate college with degrees in web behavior, web behavioral psychology. That didn't exist when I went to college. So that's how I would answer the question. Jim, I'll turn it over to you.
Okay, well, I'm going to pick up a bit on what John said, but in a bit of a parallel. I mean, there's a lot of great industries out there that I think are poised to do well, but I've spent a fair amount of time with clients of ours in the packaging space. And packaging is a very fragmented industry still, and it crosses over many different types of products. There's obviously flexible packaging and paper packaging and rigid packaging and packaging for healthcare, medical. There's technology being embedded into packaging. So I do see, as you assume that if our last panelist, the keynote speaker from Fifth Street is correct, not only about the top of the market, but about velocity of transactions and the economy coming back, the packaging industry, which has lagged the other industries in terms of stock price indices and multiples in terms of M&A, there'll be expansion there and growth there, and I think growth and activity too. So that would be a sector I'd watch pretty carefully.
I'll just toss out one more, just in the interest of being granular and not talking about general trends, but a specific sector. As we look across TMT to find specific pockets of activity that are likely to be really high in 2014, the obvious one that jumps out to us is cable. Many of you probably followed the Liberty Charter attempt to buy Time Warner. It's been all over the press, and there's potentially activity going on this week. That has largely frozen what was a very hot market in 2012. So in 2012, 5 of the largest 7 transactions in the cable sector had happened over the past half a decade, had happened in the course of about 4 months. Valuations had traded up 2 or 3 turns of EBITDA, and then all of a sudden John Malone bought into Charter, and everybody kind of stopped trading cable assets because they wanted to see what he was going to do. Well, what he did was try to buy Time Warner, and everyone's been waiting for that to happen for 9 months. So once that resolves itself, I think you're going to see a lot of assets free up. And fortunately for us, that's where we spend a lot of our time. And so I think we're expecting a very good 2014 in that sector.
It's interesting. I think we all know that the cable companies are all battling for that pipeline of getting information into our homes, and it's going to be interesting to see how that works out. And hopefully there'll be more competition, and we can all get better rates on our cable bills. Yeah. So my next question is going to be about Washington. I'm from Washington, D.C. I grew up there. I've learned to tune out basically all of politics, but the first thing people say to me when they hear I'm from D.C. is, so what do you think is going to happen? I have no clue. But I will tell you this. I think that the prospects of long-term budgetary peace are actually for real this time, and I'm hopeful that through at least the next election, we will not have to play this game of every 3 months figuring out whether the government's going to run out of money. To take it down to a micro level, like I said, I'm from D.C. I play on a hockey team, a men's hockey team. When the shutdown happened October 1st, my hockey team lost 4 players who are contractors for the government. Those people didn't get paid. So those people were out 3 weeks of salary, and apparently that was the 3 weeks they used to pay for hockey. So I had to scrounge around and get some more people. We did okay. We're in first place. Thank you. So the question to you all would be, if there's long-term budgetary peace, if what's going on now really does stick, and if the positive job numbers really stick as well, what does the M&A market look like in 2014? What does the M&A market look like in 2015? And the converse of that would be, if we end up back in this quagmire, what does that do to the M&A market? John, I'll start with you.
Man, I got to take a different seat. I get the first question every time.
Well, you know what? Let's start with Jim.
Oh, thanks.
I think the effect government has is going to continue to be very tremendous in certain segments. And I was just speaking from a person who's in a traditional bank right now, facing incredible amounts of regulation. I mean, you probably saw J.P. Morgan recently hired 5,000 additional people just to comply with various regulations. What I worry about with the government is we've had a lack of clarity from fiscal policy, and you definitely indicate that can still happen. Or hopefully today we'll hear that the Senate approves the 2-year budget. But if that dissipates, I still feel like regulatory uncertainty and the onerous nature of regulation on many of our industries is still going to have a dampening effect on M&A activity and on the economy generally.
I think I would actually say on the margins, this stability or perceived stability and its continuation are everything to the M&A market. I mean, buyers for years have been waiting for some ability to predict what their business is going to look like 1 and 2 years from now. Are they going to be able to cut costs as they've assumed? Are they going to be able to grow revenue at a rate similar to what they've expected? And everybody that's making the decisions around whether to acquire something or not, the first question they have to answer is, are we confident enough in our own business to make that decision? So for 2011, 2010, I think the answer was no in most cases, and people were pushing things off. We've started to see that really turn around, and to the degree that we can avoid any further fights over this budget going forward, I think you're going to see that will really drive M&A activity. I think it still would take another year or so of consistent peace to make that happen, but a year or two out, you may see a real boom if we're able to stay stable like this.
Yeah, I did hear the Senate agreed today to put the budget legislation to a vote, so that's a positive. They stopped talking about it,
Yeah.
and they might do their job. Wouldn't it be great if we could just stop doing our jobs and put our pencils down and wait for somebody else? I mean,
Yeah.
we'd all be fired if we did that, but Congress does it every time. So I think we are at a point where we're going to start moving towards an approach that keeps the government in business. I think that is critical. When you look at the things that drive stability, having a functioning and coherent policy that allows you to look forward is key to that confidence in making decisions. I think it also directly affects various industries. Regulation, separate from our fiscal call considerations, regulation clearly is hampering M&A activity in the financial services market. I mean, lack of direction and threat of regulation makes it impossible to make strategic decisions. And that in financial services will drive M&A in that sector, no doubt about it. The evolution of regulation, when it comes to telecom, and cable and those industries that have been deregulated. You look at the airline industry. You can joke. Colbert's got that chart showing AT&T in the 80s and AT&T now. And it's the same thing, but it's had a gazillion changes to come back to exactly where it was. And this morning they were talking about when are we going to decide that we need more than 3 airlines in the U.S. and we're going to regulate that back in. So regulation, I think, is one of the biggest, oftentimes breaks on M&A, but can be a huge catalyst for it. And the Affordable Care Act is a good example where it creates direction so you can make investments. Because that's the key. With regulation, you're dealing with longer chunks of time, which better aligns with where capital is being put. So given the trajectory we're on right now and greater stability, I'll be honest, it's the government stability and investment policies outside the U.S. that I'm more focused on. Now that Europe has an approach to dealing with the euro crisis, and the euro is currently going to survive, what's the policy to drive investment and stability in Europe upon which businesses can make investment decisions? How is Brazil going to position its economy to balance and stabilize it? I saw Obama and the president of Brazil, they did greet each other in South Africa, so apparently they're in at least hugging terms, if not speaking terms. But we already know everything she's saying anyway because we're spying on her. That's a positive. China, again, investment policy is a key to that growth. Is China going to accept a 6 to 7% growth rate or going to continue pushing towards something higher? I think those levels of stability are what drive people to put the capital to work.
No, I think that's fascinating because my perception has been that the fundamentals of the economy, aside from the government and aside from the fact that the stock market keeps going up, and up, that the fundamentals in the economy right now are quite strong. I mean, in spite of the government, not because of the government. And if the government can actually stop being an impediment, we could all, hopefully everyone's learned their lessons, and hopefully we can experience a few to 5 years of continued growth, maybe not the fire hose that we were all dreaming about back in 2008, but the growth that allows us all to continue to grow our businesses and continue to invest in good companies that do good things. And taking ACA as a classic example, that delivers better healthcare with better results at a better cost for all Americans. So we are actually right on time, which means we have 6 or 7 minutes for questions. Does anyone have any? Yes.
I think most of us are aware that this past year, the Chinese acquired Smithfield Foods for $3.2 billion. And just this past week, AIG announced that they were not selling their aviation business to a Chinese conglomerate. In terms of middle market, can any of you comment about your views with respect to your thoughts in the year ahead and the Chinese continuing to go shopping in the U.S. for purchase opportunities?
Now, I'll start off. I think inbound investment to the U.S. has certainly also been more restrained this year than you might have expected, given the strength of the U.S. economy, and that was driven by the instability and the uncertainty in the markets where that capital comes from. China invested less. Japan was a great investor this year, particularly in U.S. assets, and put a lot of capital to work. But that's more reflective where the Japanese economy was. Brazil also cut back. The Middle East cut back in terms of how much capital they're putting to work. I think they are all still definite competitors for assets in the U.S. I think the attractiveness of U.S. assets to foreign investors is because of the stability. We don't have the growth rates you've seen in developing markets. We've got the stability of cash flows. Middle market transactions, 98% of the market on just deal count, right? I mean, that's where all the activity is. And I think, with what I see from investments from China in the U.S., it is about access to resources and in some cases markets that are not otherwise in existence. You mentioned the food deal. I mean, that's a very different concept than I think most of us were expecting when we thought about investments into the U.S.
Yeah, I think that's true. I do think what has been easier for investors from China up to this point has been investing in discrete assets like real estate, and we've seen plenty of that here. And One Chase Plaza would be probably the most recent one, but it's very straightforward. You don't have to necessarily understand too much about the intricacies of operating a business. So that has been kind of their leading edge into investment in the U.S., but there's been plenty others. I think this week AMC Theaters is going public, which was acquired by a Chinese investment group not that long ago, and it showed that they're willing to invest in a U.S. company and then take advantage of U.S. capital sources to grow it further. So I think it's overall been a positive. It's just been gradual steps into a broader set of assets.
Does anyone else have any questions for us? Okay. Well, I am going to wrap up by saying I'd like to thank those of you. I think all but two of you stayed awake, and we very much appreciate that. For those of you who slept, I hope we weren't talking too loud to interrupt. But thank you all for your time, and if you have any questions, feel free to come up afterwards and ask them.